Welcome back to my 10 favorite people. Hope you're doing well. I'm incredibly excited for today's video because believe it or not, Bitcoin is trading at the exact same price it was trading at just 2 weeks ago, even though we just witnessed the largest leverage liquidation event in crypto history. Just 3 days ago, Bitcoin was trading above 120,000. Buying pressure was intensifying and investors were getting more and more confident, piling into leverage positions. We also started seeing more and more discussions on X and on YouTube regarding a Bitcoin supercycle, and this time is different, and major corrections are now impossible because of Bitcoin's new dynamics. And I was, of course, getting roasted in my comments section for being the loser with a 30% cash position as we're entering October and alt season and this super cycle, even though I still have plenty of exposure to the upside. But even with all of that extreme risk taking and leverage, there was still this underlying anxiety and uncertainty among market participants regarding the 4-year cycle and the length of the previous two Bitcoin bull markets, which lasted exactly 152 weeks from bottom to top. And this would have been the week where the same thing would have had to play out if that cycle pattern was going to repeat. And just to be clear, I don't believe the cycle top is in. I don't believe this cycle is going to be the exact same length as the previous two. I just thought it was important to mention this because if we weren't mentally prepared for it, it was going to cause a lot of panic if price started going down. And if you prefer to measure cycles from top to top and that's how you like to do it, that's amazing. Same thing if you prefer to do it from bottom to bottom. But what caught my attention is this bull market pattern of 152 weeks from bottom to top. And that's why I've been covering that in my most recent videos. So the stage was perfectly set. We had extreme risk taking by investors and a ton of leverage piling into the system, but we also had this underlying fragility and uncertainty surrounding the 4-year cycle. So all we needed was some big whales to start opening some major short positions and putting some downward pressure on the market, starting to spook investors. Maybe these were insiders that knew the announcement was coming about the Trump 100% tariff on China. But all the market needed was this type of major catalyst to cause some panic selling. And because of how much leverage there is in this market, panic selling begets more panic selling and liquidations create more liquidations. And you end up with the largest liquidation event in crypto history, nearing almost $20 billion. And you can see just how crazy these liquidations are compared to every liquidation event before it. Just a few weeks ago, we were talking about a $3 billion liquidation day being the biggest of 2025. So for this one to be more than 6 times larger is absolutely insane, especially because Bitcoin is back to the same price it was at just 2 weeks ago. And this is exactly why I always recommend to avoid leverage on this channel. I know it's very normalized in this market. I know a lot of people promote it and sell that dream. But if there's one thing that I've seen cost investors the most money, even if their long-term thesis is correct, it's by using quote unquote safe leverage and adding a 10x or 5x multiplier to their position, and they get completely wiped out on a day like yesterday, just to watch their thesis play out once their position is gone after the fact. So where does that put us in terms of Bitcoin cycle scenarios? Well, I don't want to jump to any major conclusions until we see tomorrow's weekly close. Ideally, we see the close above the 20-week moving average, and it truly wouldn't surprise me if we saw a V reversal after all of the leverage that was washed out on this crash. But if we close below the 20-week moving average, it wouldn't surprise me if we saw that full reset scenario play out and retest the 50-week moving average, which is our bull market line in the sand and our macro trend. If we close below that level, we're going to have to readjust. It's impossible to predict exactly what's going to happen with 100% certainty, but we can have a base case as to what we think is the most likely outcome. We can also look at other possibilities that we should be prepared for, whether it's because of a major headline or a major catalyst that surprises the market to the upside or the downside. And of course, even if we think there's a small chance of it happening, we also have to respect the 4-year cycle and have a contingency plan in case we do get that close below the 50-week moving average, even though I believe that's unlikely as of right now. And if you have a base case, a possible outcome, and an unlikely outcome, it's very easy to build a portfolio to best navigate those situations. I have my cash positions for days like yesterday, and so that I can buy the dip. So I will likely be buying the dip on Monday, not because I think something magical or special is going to happen on Monday. I just have a rule for myself that I can only make trades once a week because I noticed that every single regretful mistake I've made in this market when I was new was either FOMO buying into a breakout during the week or panic selling during a washout during the week. And by waiting for Monday, I get to see Sunday's weekly close. I get to take a look at the market after a reset over the weekend. So I'm usually much better at making decisions. And that's why I wait for Mondays to make my decisions and try to protect myself from emotional trading during these type of events. And this cash position also protects me in the unlikely scenario that the cycle is over and the 4-year cycle is going to play out once again. But because I believe we're either going to head higher later this year or immediately off of a V bottom, I do still have 70% of my portfolio in spot holdings that I believe are good holds. I'm not in small cap altcoins that can drop 90% on a day like yesterday. And I'm also not adding leverage and running the risk of getting liquidated and losing my entire position. And as always, I will share exactly what changes I end up making to my portfolio on Monday in Monday's free weekly report, and we'll be covering the weekly close as well. And if you'd like to learn more about my portfolio automation system or mental models I use to navigate this market or common mistakes I see so many investors making, you can check out the Crypto Enjoyers program and community in the video description. I'm very close to completing the final module for the common mistakes course, and once that's complete, lifetime access will be closing and we will be switching to a subscription. But for now, I'll be paying very close attention to how this weekly candle ends up closing. We had our false breakout wrecking all of the leverage longs that piled into the price discovery move. We also had a lot of shorts piling into this liquidation event, and maybe we'll end up creating a false breakdown to the downside, but we'll have to wait for the weekly close to get more clarity on that. And what Bitcoin ends up doing here is going to give us a lot more clarity as to whether this time is different and we're going to see an extended cycle driven by monetary policy, or if we're going to get the same 4-year cycle as always. And this is really important because if we do end up seeing this cycle extend, that is going to change the mind of a lot of OGs in this space that are betting on the 4-year cycle and selling right now, expecting price to go lower. So if we do see it extend, that would result in a lot of investors having to pile back into a more long-term Bitcoin position instead of just selling every 4 years and trying to buy back at the bottom. That's why I really like looking at the 200-week moving average to manage risk, because it's my worst case scenario for a Bitcoin bear market in terms of how low we can go, especially because it's a rising target. So by the time Bitcoin hits it, maybe it's only 30% below where price is now, compared to if Bitcoin ends up rallying a lot higher, then it could be a significantly more painful bear market once we see that mean reversion. I would love to get an opportunity to buy in the fair value region once again, as long as Bitcoin maintains that 50-week moving average. But as of right now, I don't see any major concerns as to why we need to sell everything and completely abandon this market for the time being. Investor sentiment has completely flipped back to fear, which makes me even more excited for Monday's purchase. We know that market sentiment got greedy for a very brief moment before the sell-off, and now we've seen that fully reset once again. And in terms of the hourly sentiment, this is the most panic and fear we've seen since October of 2024. And that's, of course, when we had the tariff trade implosion and everybody thought we were seeing a macro cycle top across all markets, including stocks, Bitcoin, everything. And it ended up being a local low, and Bitcoin rose about 130% from that point, and the S&P 500 rose a lot higher as well. So I really like betting against the sentiment extremes when investors are convinced it's all over. And even though we're down 1% for October as of right now, I do expect this month to still close green. We're not even halfway through the month yet, and I see so many investors saying that it's time to pack it up. I would not jump to those conclusions that quickly. We know that Bitcoin has been consolidating sideways in a range similar to the range we were in 2024 and in 2023. So until we get a close below 100K, which interestingly enough is also where the 50-week moving average is, I can't jump to the conclusion that the cycle is over. But until we get a close on the weekly chart above 125K, we can't assume price discovery has started and that momentum is going to build. So for now, as long as we're below 125K and above 100K, this is bull market consolidation, in my opinion, removing all of the leverage from the system before we head higher. And for now, Bitcoin is still holding our major support levels. Could it go a little bit lower? Of course, but as of right now, I don't want to jump into any conclusions until we see where the dust settles and get more information. In terms of the longer term trend, we're still seeing huge ETF inflows. They're absorbing more and more supply off the market, and I think this is what's going to matter in the longer term. And we're still seeing more and more issuers giving their customers and clients access to Bitcoin who haven't had it before. And I believe this is going to be a long-term trend that's going to benefit Bitcoin, but there's still going to be washouts and leverage flushes along the way. As for MicroStrategy, not looking too great here, rejected by its 20-week moving average and now back below its 50-week moving average, still looking pretty weak for the remainder of the cycle because Saylor really doesn't have a lot of room to issue more shares and buy more Bitcoin here. So I do expect it to perform in a similar fashion to whatever Bitcoin does or underperform it. I do believe the opportunity of significantly outperforming MicroStrategy is over for now, unless we get another opportunity to buy it in a bear market where it's trading at a discount and everybody has given up hope on the asset. As for Ethereum, we did see it sell off alongside Bitcoin, now bouncing off of its 20-week moving average. It would be amazing to see us close above the $4,000 range high before tomorrow's close. That would give us an even stronger sign that that's the low and we're heading higher from there. But until we see the close, we can't really tell if this is going to be a prolonged consolidation or if it's going to be a quick V reversal. As of right now, corporate treasuries have slowed down in their Ethereum purchases. Maybe they're going to take advantage of this dip and buy more next week. We're still seeing consistent ETF inflows for Ethereum alongside Bitcoin, so no major warning signs there. And Ethereum is also testing its 20-week moving average on its Bitcoin pair, which seems like an area where it would make sense for it to bottom and head higher to our target for this cycle at the 200-week moving average. But we need to see what this weekly candle ends up closing like before we get more clarity on how low it's going to go. As for altcoins, pretty painful sell-off this week alongside the Russell 2000. We know the altcoin market needs the Russell 2000 to enter price discovery so they can enter price discovery as well. So far, this looks like a major cup and handle that may still be continuing before the breakout. But until the Russell 2000 enters price discovery once again, I don't expect much from the altcoin market. The alt season index is back at 47, which isn't surprising after the price action we had yesterday. We are expecting the new US spot ETFs this week, but that could get delayed thanks to the US government shutdown. Solana ended up seeing a pretty ugly sell-off alongside the rest of the market this week, but it's holding its 50-week moving average and 20-week moving average as well. We really want to see that range high reclaim so we can start targeting more upside. But as of right now, this looks like a buying opportunity to me as long as this cycle stays intact. I still believe Solana is the best positioned project after Bitcoin and Ethereum in terms of brand recognition, US adoption with the ETFs around the corner, and corporate treasuries. We just need to see the Solana Bitcoin pair reclaim its major moving averages and previous range low before we can head higher. And you can see how damaging this previous sell-off has been across this asset class and even across traditional markets, as you can see here from the QQQ and the S&P 500. It's been a very painful week. I mean, markets have been up only for almost 6 months now, especially traditional markets. So these shakeouts and pullbacks are normal, but I wouldn't jump to conclusions that it's all over and it's time to head for the hills until we see where the dust settles and what these weekly closes end up looking like. Now, what's pretty crazy is this liquidation for Bitcoin and crypto as a whole ended up happening on the exact day that the GLI was calling for it based on the 75-day lag. It also had its local top on the exact same day as the GLI, also had its previous local bottom and a local top before that on the exact same day as well. Now, this is not how I like to use this indicator for exact day-to-day trading, but in terms of getting through the choppy period that the GLI was warning us about, that's going to end on October 13th, and then it's calling for a rally until late November. Is it always going to work out perfectly and go exactly as expected? No, but it has served us so well this cycle, and I plan to keep using it for general trend until it stops working. As for the US dollar index, it was able to close its weekly candle above its 20-week moving average for the first time since March of this year, so a bounce into its major moving averages before rolling over wouldn't surprise me. We know the market is only pricing in 4 rate cuts over the next 12 months, and I don't believe that's going to be enough. As of right now, this is what that projection looks like, and I believe the economy and the markets are going to need more than just 4 rate cuts over the next 12 months because of the current US debt situation, and we are still in the midst of a global liquidity index macro breakout, and the debasement trade is still fully underway in my opinion. Doesn't mean we're going to go up in a straight line over the next few years with zero pullbacks, no, but does it mean that our longer term macro trend for our risk assets is likely going to be up? In my opinion, yes. We know the Fed has to continue easing because the labor market is weakening. You can see it in the unemployment rate. You can see it in continuing jobless claims, and initial jobless claims are in an uptrend, even though they haven't spiked quite yet. And inflation is low enough that the Fed will likely start prioritizing the labor market over inflation because inflation is at least below 3%, which is significantly lower than when it peaked in 2022. And we know the Fed is doing this while US real GDP is still positive, and the forecast for Q3 is still quite positive as well. We know the Fed is still doing quantitative tightening, but they're going to have to go back to easing eventually, which is why the S&P 500 has been on a tear, even though it's had a recent correction, but that correction is tiny compared to the 40% rally it's had since the tariff bottom. And it's no surprise that this small correction for the S&P 500 is dragging Bitcoin as well. Risk assets do tend to be correlated, and I don't believe this time is any different. Gold continues to go on a tear and rally higher, and I believe it's only a matter of time before Bitcoin does the same, because if we look at the medium to long term, the US federal government is still running huge deficits. That trend seems to be worsening year after year. Exponential debt growth means exponential money supply growth and currency debasement, which is good for the risk assets we price in fiat currency like the S&P 500 and fixed supply risk assets like Bitcoin. But as always, let me know what you expect. Thank you so much for the support on the recent videos. Thank you so much for watching, and I'll talk to you soon.